Hello and welcome to this CNBC TV 18 special. My guest is someone who is always a special guest across financial channels, the Governor of the Reserve Bank, Raghuram Rajan. Thank you very much, Governor, for giving us time specifically for CNBC TV 18 because this is our 15th anniversary. This is our birthday week and it's really nice of you to be part of the birthday celebration, as it were.
Well, happy birthday.
Thank you very much. First of all, I hope we will continue to get this chance to interview you as Governor Reserve Bank. I hope you're not going away to the BRICS Bank.
No.
No, there was reports saying that your name was mentioned.
Well, I have not heard anything about it.
You have not been told, not asked.
Well, let me put it this way, that I mean, this is a job that I'm doing. It's the only job I care about. I'm happy here.
No, you are happy here, but it's quite possible that you may be requested to take on.
Well, that's a hypothetical question.
You haven't so far been. No, I'm not indulging in hypotheses.
I have not been asked about it, and I'm very happy here.
All right, fine. Now to concentrate on the job at hand, as you say, the job you love. What is the sense you are getting about the 6% in March 2015 and the 6% in January 2016? Are you getting a sense that you will achieve it a little more easily? Can you give, say, a chance of more downside surprise?
Well, look, let me put it this way. Every reading we've had on inflation since I would guess November of last year has been, good.
Yes.
And so that is suggesting that something is happening in this economy which is changing the environment. Now, of course, after 5 years of very high inflation, we should not be faulted for trying to make sure that this is the real thing, because we've had false alarms before. But I think every additional sort of inflation reading we get seems to confirm the trend. And our policy was basically saying that we need a little more comfort, but we want to do this in such a way that, barring exceptional eventualities that, we can't foresee, that when we change in a direction that is easy to anticipate, and you would anticipate that further moves would be in the same direction.
No, what I'm asking you is, do you suspect that given that you've got downside surprises, very pleasant ones over the last 12 months to the inflation reading, is there a decent chance that that will continue? Well,
I'm hopeful, and what we want to do is see if that actually happens. Okay. But I think all the macroeconomic surprises India's had over the last year, somebody's watching out for us, have been positive.
Yes.
So, let us hope the trend continues. Of course, if you were mean reverting, you would say, well, we've had so many positive surprises, now we should start seeing some negative surprises.
Okay. Before I come to the negative surprises and their absence, what according to you should be the positive real rate of return? Because at 6%, it is 2 percentage points, the positive real rate. Is not that enough for you? If you see so much clarity up until the next year, do you want it to remain at 2% or you would be comfortable with 1%?
Well, the real rate that should prevail in the economy depends on so many things, including what is your comfort level with the rate of growth, the kind of investment cycle that you're seeing, etc., etc. So obviously, when the economy is weaker, the real rate that you would expect would be lower, and as it strengthens, you would expect a higher you would want a higher real rate to prevail. If you look at the world, what real rate is prevailing in other economies, I would say it's in the 1.5 to 2 range for developed countries, and for emerging markets a little higher. So, we don't have a specific precise number in mind, but I think the range would be somewhere between 1.5 and 2.5 that would be a perfectly acceptable real rate.
If that is the accepted or acceptable real rate, and your forecast is that inflation is going to be in and around 6% through calendar 2015, there isn't so much scope for rates to fall at all. At best, 1 perhaps.
Well, you're making that judgment. I am not going to verify or deny that judgment.
You said was the trend you spotted was yours.
Right. What I will say is that, obviously the scope for further rate cuts depends on of significant rate cuts depends on the pace of the disinflationary process. Now, 6 is not a magic number that we hope to stick to. Over time, as you know, it has to go below 6, if the government formally approves the target of 4 plus minus 2, then we would be nudging closer to the 4 over time. Now, that time frame over which we reach the 4 has still to be determined and so on. But that would give you more room at that point to cut more. But you're absolutely right that if there is a certain real rate that we need for savers in this economy, that means a certain amount of room, and that to get more room, inflation has to fall further.
Okay. In that case, is it possible, or is it very much in your thinking that the 6% 2016 target is a very transient target? You will find yourself bringing it down in the months to come?
No, I think that it is important to, when you set something, to stick to it.
So do you see it coming is what I mean, because you have had positive...
We may undershoot the target, and if we undershoot the target, we're not going to feel uncomfortable about undershooting. Of course, if we expect to overshoot the target, we'll try and bring it in within the target. But the time over which it's going to reach closer to the central point of the band is something that will have to be determined as we formalize. So what is the period over which we're going to look at meeting the inflation objective? It doesn't mean that we have to be at 4% on January 2016. And as I said in the interview, in the policy announcement, that if we get to 6, we are at the extremes of the target, and that's not what I mean. If we do better, that's fine. But at this point, we want to get to 6.
But why have you all maintained it at 6? Because a lot of your base assumptions were $100 for crude and the rupee at 60, global growth of a certain order. Some of them at least have changed.
Right.
Haven't you changed any of your assumptions? You haven't inputted them?
We have input them. And at this point, remember, it was the model was saying 7% in our last policy meeting.
Okay.
Now the model is, I would say, saying 6.2, if I remember correctly, 6.2. But in the previous policy meeting, we said our subjective assessment over and above the model is that we're probably overestimating the inflation and developments since then have corresponded to our intuition that the model itself has come towards where we thought it would be. It's now closer to our comfort range in terms of where we think it will be.
Okay. When you said that the government is in sync or is agreeable to your medium-term inflation target of 4%?
No, let me change the sequence. The government sets the inflation target.
Yes.
We meet it.
Okay.
Right? So the government is comfortable with proposing an inflation target of 4 plus minus 2. So, of course, there have been a lot of studies that have gone into this, right from, I think, Narasimhan proposed 4%. So 4% is a magic number in the Indian economists, but there's a logic behind it. Think about 2% is what inflation targets in the world is, and say our productivity differential is 2%. So if we want the rupee to be relatively stable, the nominal value of the rupee relative to major currencies, then a 4% inflation would keep us relatively stable, assuming others are at their inflation target. So that is one rationale for the 4. And the plus minus 2 is because we're at the early stages of trying to maintain inflation within a band, and some leeway there has to be for the additional noise and the fact that expectations aren't as anchored here. So let's see.
But have you actively discussed a target from the government? No, was this 4% discussed with the Prime Minister or the Finance Minister or the Finance Ministry?
This is the discussions are on with the Finance Ministry. That's why I said, partly because, you would want to know what is going to be there post-January 2016. The Finance Ministry indicated its comfort with this number. Now, the details have to be fleshed out. I just wanted to give you a number beyond January 2016, that this is probably what we're going towards, and the details of when, how, etc. will have to be
No, in that case, were you not pressured into cutting rates, or you don't expect further pressure because this is the government's given target?
No, look, the word pressure is sometimes used, bandied around in the press. I think we have a very healthy dialogue between the government and the Reserve Bank, and the government says, here are the things we are seeing, here are our concerns, here are our hopes, and we describe to them what we're seeing, what our concerns are, etc. I mean, there's a sensible discussion of the economic environment and the need for policy. And I think if you go by what the Finance Minister has said in public repeatedly, I mean, that is what he says in private, which is that here are,
he said repeatedly that I hope he cuts rates.
No. So what he's added there is that ultimately it's the Reserve Bank's decision, right? And that's how you expect the dialogue to go on, that here are my views, here's what I think, but it's your decision. And I think that we and the government have a healthy dialogue. They understand our concerns, we understand their concerns, and there's a meeting of the minds, and that's how these policies, essentially are discussed.
Okay. Well, let me come to the global environment. What is your sense of this commodity super cycle? It seems to be at its ebb or lowest ebb at this point in time. Since you've read the global economy for so long now in various previous avatars, what is your sense of the commodity cycle in 2015? Will it be benign to us?
Well, I think all indications are benign, and primarily from a slowdown in China, which is creating the impetus. In the oil-producing countries, I think the fact that they've had a number of years of fairly strong oil prices has elevated their budgetary requirements. They've essentially started spending more, and therefore a number of countries need fairly high oil prices to meet their budgets. So with oil prices going down, the only way they have of meeting that is to produce more. And that is why there's a reluctance to cut, and there's a sense from some of the big oil producers, I've been cutting all the time, why should I cut once more? And a point that Dr. Urjit Patel mentioned, perhaps also a belief that these periods of fairly low oil prices, if sustained for a little while, can also be good for the oil producers in shutting out further production. This is the predatory pricing idea. But all said and done, I think at least for the near future, I'm not sure what the exact oil price will be, but it seems to me that it is going to be relatively benign, given that strong demand seems unlikely to emerge for the foreseeable future.
If that's the global cycle, and in India itself, you're seeing inflation slightly benign, do you think now the threat from a Fed tapering is not very serious? At least by the time it hits us, 10 others would have fallen.
Well, I've said that if you wanted to discriminate between emerging markets, we have the label emerging markets, so we could get hit if there's a general emerging market concern. But typically after some time, discrimination starts. And once people start discriminating, there are a number of positives about India that they would tick off, including a stable and strong government, indicators moving in the right direction, and of course our immense potential for growth. So put all those together, I doubt we'll be first on the list to be to be hit.
But relatively, is that a risk you don't have to worry about?
You never say, you never
risk?
say I'm not going to worry about anything,
No.
right? I mean, they're always out there as things that you have to pay attention to. But I think we're well prepared. We are certainly much better prepared than we were in May 2013. And I would say after the first flush of investor sort of concern, I think we will see some discrimination.
Okay. Is one of your ways of preparing to ensure that the rupee doesn't get overvalued vis-a-vis the real?
No, our attempt is, I mean, I've said it many times, to ensure there isn't excess volatility in the rupee. And when we see, and that means not just current but also prospective. So when we see a whole lot of money coming in and we're not sure of the durability of that money, we try and pick up some of that money so that it doesn't overly influence exchange rates both on the way up and on the way out. But apart from that, we understand fully the limitations of trying to maintain a particular value for the rupee. You need a much more restricted financial market than we have to believe that you can do it over the medium term.
Yes. No, actually, the way you have been as a governor in terms of foreign exchange intervention is quite a distance from what you had written in the financial sector report that you wrote in 2008. So, I mean, what has constituted this change? A realization that too much of overvaluation is what causes disruption?
No, I think I said exactly the same thing, or we said exactly the same. Remember, I don't write the report myself. There are a bunch of people together, but we said that intervening to prevent excess volatility were words in that report also. So we're doing precisely that. We also said we have to caution against against trying to maintain a value over the medium term and against what seems like the forces of the market. And
are you saying you're not moved at all from your position in that report? I mean, you certainly have escaped phrases like this, but reality after the global financial crisis has moved your position.
No, so we saw some of the global financial crisis while writing that report. It was September 2008 when it came out. But my sort of formal view is probably contained in something that a paper that Barry Eichengreen and I and Ishwar Prasad produced as part of a committee. And our view is that central banks should worry primarily about inflation, but monetary and financial stability is also something that they should be concerned about. And sometimes large changes in asset prices, whether it's exchange rates or credit and asset, equity inflation, is something you have to be worried about. So yes, you need to take some actions there, but be realistic about how much you can do.
What was the thinking behind suddenly allowing gold imports to be allowed? Is it because you were worried about the rupee appreciation and this torrential inflow of FII money?
No, I don't think that was the primary
reason.
Back of the mind, maybe that we have to be equally willing to let inflows and outflows. But I think the primary reason was the distortions created by the 80-20 rule. And there was a concern that certain entities were perhaps misusing it, while others were being bound by it. So it created a very unlevel playing field. So there were, a number of options discussed, and I think we went with the open it up.
Okay. No, I mean, this distortions and the fear of smuggling was always known. But you chose that time because crude prices fell and because FI investments were high. The rupee is simply not depreciating like other currencies are vis-a-vis the dollar.
Right.
They've stayed at par, almost 62.
Right. So we felt more comfortable. Remember, post the measures in July, August of 2013, we said we will slowly unwind these measures.
Okay.
So I think unwinding it was on the cards. The only debate was when. Do it now, do it later. And there was a healthy debate after which the decision was taken.
You're comfortable with it? Okay, just one more word about monetary policy, and then I have some questions on banking. According to you, what has allowed this undershoot of inflation? What are the trends? Is it like fall in rural wages, or is it the government managing the food sales from the FCI well? What were the signals, according to you, if you have to dissect this positive inflation surprise, what would you attribute it
I
to?
think there are a whole bunch of factors, right? And including luck.
Okay.
So luck is the stuff we can't explain. So that's also helped. But I think food management by the government has been important. The fact that minimum support prices haven't moved up through two governments now at a substantial pace. Now that's not entirely just driven by women fancy. It's driven by the cost structure, which hasn't gone up. Part of the reason also has to be that we are closer to international food prices than we were when this whole process of increasing MSPs took place. And so there's not that much more room to do it before you hit against the fact that imports are cheaper, and therefore they could come flooding in if you start moving domestic prices much more strongly. So food has been a big factor. We still have work to do, which is the seasonality in vegetable inflation. Can we bring it down? Can we ensure that there is storage movement, etc., less wastage? And I think the government is undertaking actions on that front. The other aspect is, I think once there was a sense that inflation was coming down, it assumes a life of its own, because remember, we worried about second round effects, the effects feeding into services. Services too have started coming down. Housing, you can see some impact finally. It used to be 10% every year. Now it's slowly starting to come down. It's in the high 8s, early 9s. So I think across the board we're having some impact. And let's see.
No, are you getting a sense that these factors, be it rural wages or government management of stocks, or for that matter, global commodity prices, global corn, wheat, food prices, will sustain through next year? Do any of these look secular to you?
Well, I mean, I don't think global prices are going to take off that rapidly unless there's this concerted failure of the climate issues across the world, as I think was the case in 2007, 2008. But apart from that, it seems to me world food prices provide that ceiling beyond which domestic food prices can't move that much. So that is going to be one good thing. I think food management hopefully is a secular positive, that we improve it as time goes on, and as a result we move food to where the prices are high. Farmers make proper choices between what to produce so as to bring down prices longer run. So I think these are steady trends. Hopefully we will not be the only large country in the world experiencing double-digit inflation. I think right now we look like we've escaped that well and truly.
Now I'm just checking where somewhere, if in your study of these trends, is there an expectation that we may undershoot next year as well on inflation?
All this was an elaborate ploy to get me to say something about. No, we may. Let us see how the numbers look.
I mean, are you that confident of rural wages, because they've been coming down for a sustainably long period, that the government has obliged on food stock management?
Well, when you see a trend over a substantial amount of time, you believe there's some underlying economic force pushing that. What was pushing up rural wages was a combination of things: higher agricultural prices, but also a substantial increase in construction, that. Now, because construction has been, moderate, and you have seen some fall in rural wage growth. It's still growing, but not as fast as partly maybe the participation rate, women leaving the labor force to study, maybe that has also plateaued. I mean, these are things, there's so many things going on, it's hard to put your finger on one thing and say this is what it is. But the fact that there is a trend gives you some hope that it will continue.
You've indulged me with more time than you promised me in the beginning. Thank you very much.
Thank you.